Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Welcome to Private Banking Strategies Podcast with Vance, Lowe, and Seth Hicks. Hi, Vance. How are you?
I'm doing wonderful, Seth. How are you doing today?
Doing great. I'm excited about this podcast we're doing. Today, we're going to talk about some frequently asked questions about private banking strategies. So these are routine questions that people have that I think will provide a lot of value and help educate listeners into how to maximize private banking strategies. So often we're asked, can you put a lump sum into a private banking strategies contract? Can you do that?
You know, I am so excited about that. We get that question all the time. There are people out there who have started hearing about a better way to store their safe money and a better way to use money than what they think they should be doing. And so everybody's questioning what's going on with government, everything else, banking, and this. And so some of the top questions, this is one of those top questions, is how fast can I fund money into these contracts? So can I super fund them? Can I dump money in? Can I, how quickly can I do that? The answer to that question is absolutely yes. You can super fund and you can dump in money into these contracts, but under a guideline. And it depends on what the goal is for that money. If we break the rules going in, it will create a modified endowment. Will that make you worse off than you are today? No, you'll still be much better off, okay? But it is the best way to go? Maybe not. Maybe if we can stay on the right side of the fence of those rules, we could probably enjoy much more privacy, no reporting, and no tax issues at all. So,
Right.
yeah, I think we can do that. I think what we ought to do is maybe go into a little bit more depth, maybe give an example or something, because this is a pretty hot topic.
Sure. Well, when we talk about safe money, I mean, it opens up a whole Pandora's box with regards to where's the best place to store cash. And we've talked about this many, many times, and we've got a lot of resources on it. And you can't help but address the safety or the lack of safety in centralized banks. So in 2012, under the Obama administration, the Dodd-Frank Act was initiated and enacted into law. And that piece of legislation effectively treats your deposit into a centralized bank like Wells Fargo or Bank of America or Chase, JP Morgan Chase, or any of the other centralized banks as their deposit, their cash, and you have a right to access it so long as they don't become insolvent. And if they become insolvent, they effectively can bail in on your cash. And so the next line of thought that people always have is, well, what about FDIC insurance? Doesn't that guarantee my deposit up to $250,000? Well, it does on paper, but how good is the paper that promise is written on? When you analyze what the FDIC is worth, on its best day, it may be $100 billion. There are $20 trillion in cash deposits in American banks. $100 billion in FDIC insurance will not cover $20 trillion in cash deposits. Needless to say, it's a penny or less, depending on what the real value of the FDIC is. The only way that they would be able to make good on that promise is for the Fed Reserve to print $20 trillion worth of funny money, and that would tank the entire economy. So as far as safe money goes, putting your money, your cash money, into whole life insurance contracts properly structured is one of the safest places it can be on earth. And in the right states, it's actually protected by law from creditors. So there are numerous states, generally in the South, that protect the cash in these policies, unlimited. So you could have $50 million in cash value in your life insurance contracts and it'd be completely protected from creditors. But that doesn't even take into account, Vance, the fact that when you put your money in a centralized bank, they effectively pay you nothing, and they make a ton of money off of you because of what's known as derivative lending and fractionalized lending. So they take your $100,000 that you deposit there, and they take 90 of it and go make other loans. And they have a 10% reserve or less, depending on how big a bank they are. And they make a whole lot of money on your 90,000. They don't pay you anything. In fact, they probably charge you fees for bank wires, fees for ACH, fees for too little of a deposit, maintenance, fees for this, fees for that, which effectively makes it a negative interest rate. But when you have it in an insurance contract that's properly structured, you're actually making money on that, average 4 to 7% a year, compounding. So when we talk about safe money, you have to analyze those aspects of what I just described. I mean, you can't make that in a CD. You can't make that in bonds or money market accounts, 4 to 7%. You're only going to find that type of availability in the life insurance, and it's guaranteed.
Well, back in the day when life insurance companies were the banking equation for the average American family, the returns and the gains in these life insurance contracts far exceeded the stock market. Purely safe. These are contracts, these are written, these are not assumptions. The only part of the assumption in a life insurance company would be the profits annually. And we only deal with companies who have never not paid a profit in their entire existence of over 100 years. When we talk about safety, Seth, Seth mentioned that the life insurance industry is safe. They're grandfathered in the Dodd-Frank Act. If they use their cash value reserves and they put that in a bank, they have a special dispensation where that always has to stay in cash reserves. They can't fractionalize away this cash value in those accounts in those banks because that money has to be there. Life insurance companies have to be all times, 100% of the time, fully cash reserved to cover all of their life insurance cash values. Okay? So back in the day when banks first started, they had to compete against the life insurance business because the life insurance had all the money. And so they came in to schools and every place else to educate or brainwash, however you want to put it, that the banks were the safe place to put it. And they were going against a very bad history because banks were robbed right and left as they were starting up. The more banks that were there, the more robberies that occurred. Bonnie and Clyde and, all of these bank robbers out there that robbed banks. And so the money just wasn't as safe. So they had to come up with an insurance, FDIC. They had to come up with a way to compete to get more money. And so the interest that they offered in savings accounts and their checking accounts were above 5%, 6, 7, 8%, depending on how long you had them. And this is what's called yield, folks. Yield means money put into your account that cannot be reversed. The stock market has to be average rate of return because there are no yields unless you're doing, this type of account in the market where the value of that account will fluctuate. Stocks fluctuate every day. Mutual funds fluctuate every day. You have no idea what the earnings are really going to be. Banking doesn't work off that. Banking works off of 10 years from now, this account's going to be worth X, and that's exactly what it's worth or more. depending on the profits. So you know ahead of time what your future values are going to be. And this is where the banks keep their safe money.
Banks actually keep their safe money in the life insurance contracts. And we've talked about that in previous episodes about the annual premiums that banks pay for life insurance policies. And the reason being is because there's no market risk or loss, and there's a guaranteed predictable growth that's many times higher than any other place to place your conventional safe money.
Right now, if you want to go get a loan at a bank, how hard is it?
Of course, there's rigorous loan application processes for most collateralized loans. And contrast that with accessing cash value in the life insurance contracts, there's effectively no qualification because you're the lender yourself. You're
Yeah.
able to access that cash value.
So you have to disclose to a bank where you may have a whole lot of money, your business and all your accounts. You have to bring in tax returns. You have to bring in everything, and you got to collateralize. The banks don't stop when they've got enough collateralization to cover the loan you're asking for. The banks want total control. So they're really not happy even at 100 times that collateral. Oh, well, we've got this, but we need you to sign over your inventory for your business. We need you to sign over all of your machinery, all of that in order to cover this $25,000 loan. They want it all. They want control of your personal affairs. They want control of everything. So it's very, very hard at times, especially when money's tight, interest rates are going up, to get loans, because when they find a hiccup, they want you to disclose, oh, well, there was this 6 years ago. Why did you have that? How have you solved that? Like Seth said, with an insurance contract, you are an owner of the life insurance company. You get special privileges. When you call up and you want to borrow money out of your account, that's how we use money from our cash value. We borrow it so we can put it back. So that's an in and out transaction. That was virtually the banking equation. So we would borrow money. We don't borrow our own cash value. We borrow the cash reserves of the life insurance company against our cash value. That's a plus because our cash value stays there and earns the guarantee. Now we pull money out and we can put it to work or purchase something that we can finance back into our policy and use money over and over and over again, just like the banks do. The banks always get the money back. We can always get the money back by using our contracts. They only ask 2 questions, Seth. The 2 questions are, how much do you want? Where do you want it sent? That's it. No
Right.
payback, no time frame, no why do you need to use the money, nothing like that.
Right. And the flexibility that the policies offer are really unbeatable. And so that's much different than 401ks or IRAs or other government sponsored retirement plans that a lot of folks have, and where they have all sorts of strings attached to them. You can't access your money before you're 59 and a half without penalty. You have to access it after you reach a certain age or you'll have penalties, and you're going to be taxed on it no matter what. And that kind of brings us into one of the follow-up FAQs that we'll get into, which is, what's the taxation on those? Can you roll over a 401k into a policy, or can you access that cash there and put it into a better place?
There's another advantage of using your cash value, being able to borrow it out and put it to work. And we show people, we actually have people put their numbers into our system and we show them what can happen over an 8-year period of time. And we show how getting the money back and reusing it over and over again can work in their advantage. And one of the topics we've got here as a solution for our number one question is debt consolidation. It's funny, but the average American has more than 6 credit cards, and the average American has more than $45,000 in debt on credit cards. Just trying to manage those is a nightmare. And then you add cars and you add, student loans, you add all kinds of things. It's mind boggling. If we organize that, we put all of our money to work for us instead of someone else. And that's another topic. Who's the money working for, you or someone else? If you get it working for you, you buy debt and then you switch the payments. You still make the payments to pay everything off so the money comes back in, but we start buying the debts with that volume of payments called volume of return on money at work. So if I put $10,000 to work and my payment, I bought a car loan, the remainder of a car loan, and their payments were $500 a month. The volume of return is the annualized payments, or $6,000 divided by the money at work, the money we had to come up with to buy the debt. That's a 60% volume rate of return. I don't know about you, but that's high enough for me. Okay.
Right.
That's a large volume coming back in your control. That $6,000 every year could buy more of your debt. And people are just unbelievably astounded, but they know that it's true because they see it month by month until it happens, how they purchase their mortgage in 5 years and they didn't change the payment.
Right.
They didn't change how they live. They didn't save extra money to change their lifestyle. All they did was change who gets the money. And this system sets you up to be able to do that. Debt consolidation is a beautiful way to do that.
Absolutely. And one of the fascinating features of these non-direct recognition policies is that the money in your policy continues to grow as though you never touched a dime of it. And you're actually using that cash value to pay off other debt, and it's growing inside your policy, compounding year after year with no taxable event whatsoever. And that gives you what's called the velocity of money, the ability to have multiple touches on a dollar and use it in multiple places at the same time. There's no other instrument that you can do that with.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
But this education was taken away, Seth. All of these things that we're talking about now used to be had from kindergarten through master's degree on how to set up your own private economy, run your home, your family affairs like a business, like a corporation for profit. We don't hear that anymore. We don't do that. Everybody's discouraged not to do that so that they fall victim and become slaves to the system. Whenever people give up principal, which is your take-home money, you become a slave to the system to have to replace that money. You got to work for everybody else for you to net what you bring home. We all fall prey to herd mentality. If everybody's doing it, it must be right. Well, folks, our podcasts are full of trying to make people aware that the herd mentality is wrong. It's dead wrong. It's failing. But they're failing with company. So as long as they can commiserate with each other, they think it's okay. Or it's the mentality that if enough of us keep doing the wrong thing, it will become right. And look what's happened to government. Everything is turned upside down. Good is bad, bad is good, right is wrong, wrong is right. It's just the way of life here in America now. But in a 401k, it was designed to take control of your money, to take it away from you and put it in the control of the people who have the money so that they could double it every 2.5 to 5 years. I search high and wide for a 401k to grow like that. And unless it's in, exotic or real estate or something that people are highly leveraged, they can never do that in that amount of time, especially through an employer owned 401k. We don't even own these accounts, folks. We don't own 401ks or IRAs. And the control is just like Seth said earlier, is that they mandate how you can touch it, how you look at it. They know how much it is. They're always aware of what this account is. And I believe that I had articles back when Obama was first put in. It's called the Nancy Pelosi bill. It was a confiscation bill to be able to access all ERISA-owned contracts to shore up Social Security. And once that was passed, we've not heard how bad and how tenuous the situation is with Social Security. It's kind of a Ponzi scheme. They're relying on new tax revenue coming in to pay out Social Security instead of using what they've collected over the years. So they're very, very much in control. They hinder professionals from helping people move out of these things. They don't want anyone. If you read the law, the SEC rules in the federal government, a professional is almost prohibited to tell somebody or show someone how to roll over and get out from underneath this. So because we're in it, we've got to pay the maker. When we go into this banking, we want ourselves free and clear of government. We don't want government ties. If you were to roll this into that type of a contract, nothing changes. They get total control of that contract. Okay, tax-wise, everything. The question is, are taxes going up or are they coming down? I have not in 30 plus years ever heard anybody tell me that taxes are going down. And yet they think they're getting an advantage by paying today's tax rates or saving today's tax rates to pay a higher rate later on. The only way they possibly could pay a lower tax rate is if they fail. I think in the back of everybody's mind, that's what they think is going to happen. We're not going to really have any money, so the money we pull out of here will be taxed very little. But I tell you, one of the biggest irritating things in managing assets for clients was every time they turned around, they had to pay taxes. Every time they pulled a little amount out here, they had to pay taxes on it. They had to report it, blah, 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 over and over and over again. One of my best friends, that's all he complains about today, is that every time he uses money, he has to pay taxes. So folks, let us show you a way to move 401k or IRA money into this strategy, into this type of a situation with the least pain possible. And you'll immediately be able to see how fast you make the tax money back as if it never was gone. That's another thing, Seth. But if someone says, I've got an $800,000 401k, I've got $1.5 million 401k, I've got a $3 million 401k, do they have $3 million or for whatever the amount is? No. If they're under age 59 and a half, the only money that they are entitled to is the after tax and after penalty money. So about 55 to 60% of that total is all that they get to walk away with. They solve their future planning on the million or the total amount, and everything goes wrong and everything gets eaten up during their lifetime. So folks, there was a comment made by the guy who invented 401ks. What has he told us, and what's the advice today for everybody?
The father of the 401k has come out in recent years and described it as a monster and moved his own money out of those vehicles into life insurance contracts. And for all the same reasons that we're describing, because you don't really have any control of it. The money that you think is yours is not your money, and you're going to be taxed when you try to access it, and you may be heavily penalized depending on when you need it. You've got no flexibility, no liquidity, no control, and that's why we want to show folks how to move that money into a life insurance contract where the taxes that you do pay for accessing it and any penalties that you may incur are swiftly swallowed up by the gains you make in the compounding annualized growth in a tax-free economy, in a truly tax-free economy, and where you have access to it. So it's like comparing apples and oranges. It usually takes some working through the numbers to help people see through the illustrations how they're going to benefit from that. But once they see that, it's a no-brainer.
Yeah, we have dealt, especially myself, for 40 years almost in dealing with this problem for clients, how to get the best value and growth. So on the 401ks, folks, know that is a ticking time bomb. Know that you need a strategy to get out and get out today. If you can get out and pay today's taxes, I don't know if people were privy, but there was a vote in Congress. I don't know. They kept it hush hush, but the minimum tax rate was going to be 34%. And it was just unbelievable amount of taxes in that. So hopefully sane minds prevailed and they shot it down. And it came from the Biden administration was the new tax policy that they wanted in force by the end of the year. So they haven't said anything. So I don't know whether it passed and they're waiting to drop the bomb or whether it failed.
Let's shift into another commonly asked question about private banking, and that's how can the private banking strategies protect you from coming tax tsunamis? And a lot of times people we analyze, are taxes going to go higher, like you just intimated, 34% lower rate tax bracket seems absurd. Or they're gonna go lower with a $35 trillion debt and increasing parabolically with the printing of money. There's no way that taxes can't go higher. The question is, where do you find a silo to protect yourself from that, and how do you do that?
And we're trying to present that. This is a strategy that made America strong and powerful, and it was taken away from us when the Federal Reserve was born, when they mandated the IRS. We didn't have the IRS before the Federal Reserve was born. We didn't have Social Security taxes, and we didn't have the mandate on education like we've had to completely eradicate money ideas, independence. And instead, they put in socialistic and communistic programs all through school, all the way up through master's degree. It's all about the group. And folks, you need to find out about this stuff if you haven't. Read some detail, find on the internet stuff that is correct. The Nelson Nash Institute.org is the perfect place because this is where everything was originated. So it's important that as we hear things, we act. With this question, how to avoid the taxes, if your assets are held in the safest place on the planet, it doesn't matter what taxes are going to do. As long as you got in there the right way, after tax money, you can grow accounts. These accounts are not reportable. The insurance companies do not report the growth, the results, the loans, or anything else on these contracts unless we've broken a rule and they've become a modified endowment, and they are traceable. So let us show you how not to have that happen. Seth, I think people don't understand, and everybody is always worried, can I retire? It used to be, well, when I retire, will I outlive my money? Now the question is, can I even retire, let alone outlive my money? How would you like to be in a economic environment, your own economy, where you start at X and have a lifestyle change? Because I personally don't believe in retirement. I believe that it's a change. We don't go out of production. No town ever quits, ever retires. And that's what we have to become like. Have us worth X amount of dollars when that happens. And then when we check out, when we die, it's 3 times greater. It's not less. It's more that we pass on to our immediate and extended family, and they have access to that money and can self-finance and grow it another 3 times, another 4 times greater.
Right. Well, with market-based retirement accounts, you've got that risk and that unknown of what your retirement will actually be when you need it. And you also don't know what the tax rate is going to be on that nest egg when those days come. You don't know with any degree of certainty because it's impossible to predict. And as our national debt grows, the taxation will increase. And it's really a ticking tax time bomb. You're sitting on a tax time bomb. But when you implement the life insurance contract strategies, you've got a tax-free economy where you do know you have predictable growth, 4 to 7% annualized compounding growth, and you can withdraw a retirement stipend that you structure based on a known number with no taxable event. So you're not going to have to pay any taxes, and you can predict exactly down to the month what your value will be, and you'll be able to access that with clear planning.
One of the things that always amazes me is that with people who do investing in the stock market, oh, we had pretty good results. Stock market's doing this, it's predicted to do that. The stock market wouldn't even be here at the time Obama was put in if the government didn't add to the stock market. They had to actually fund over almost $1 billion a day to keep the stock market alive. The stock market, to me, is completely false. The whole system, is designed to make the brokerage houses, the stock exchanges, money at the expense of an investor. One investor cannot make a profit unless an opposite investor loses money. And he not only loses what the investor makes, but he loses all the fees on top of that. So it's never been a win-win situation in the stock market. It's never been a fair situation. And especially now, it's totally counterfeit because remember, it was just a couple of weeks ago, the stock market really took a dive. The only reason it came back was the billions of dollars the government threw back into the stock market to prop it back up. So that's not a place I've had to even go and invest in since I've learned about the strategy to double money every 2.5 to 5 years.
Is it too late, or am I too old to start a private banking strategies policy?
Seth will tell you guys about a book we authored, and it tells a little bit of my story getting into this. I'm always searching for good, sound money practices, and I read a book by R. Nelson Nash called Becoming Your Own Banker, and it clicked. It was correct. And one of the first questions I asked, because I called the very next day Nelson Nash's office, and I actually got to talk to him. And that was the question I asked, am I too old? I was 54 years old, clear back then. And he laughed. And he came back and said, look, I'm not laughing at you. I want to laugh with you. Anyone has the same opportunity whenever they start as anyone else. The older people just don't have quite as long. And Seth and I have shown people the time value of money and how money doubles. And in Nelson's book, and we've done podcast after podcast, you're always going to start on year one. If we procrastinate, that's our problem. I got extremely angry and frustrated that I didn't know about the strategy, and I was a money manager for 37 years before I found out about it. I was very angry. Look, where was this? This could have made the difference not only for myself, but for all of my clients, because in this situation, they will always win unless they steal from themselves. That's the only way they can lose, is they steal from themselves. They don't pay back what they've agreed to do. And I'm angry about it. Who's to blame? And so he started teaching me, and it was just amazing. All the way through, I understand now. Our world is corrupt. They're trying to take over. They're trying to do this. So, folks, do yourself a favor. You're not too old. It doesn't mean the policies have to be on you. These contracts can be on anyone you have insurable interest. If we're older, we're in our 70s and 80s, we can put contracts on our grandkids. We can put contracts on our kids. I like to leave the kids alone because I want them to do their own, but I'll go to the grandkids and I'll start teaching the grandkids this strategy, help financing their bicycles and their iPads and their phones and stuff. on their own through an allowance before they're able to work, to teach them the concept of self-banking and financial independence. So you're not too old. Seth, I'm sure you've got a few more comments as to why we're not too old.
Yeah, you're never too old. And some of it relates to the 7 pillars of private banking strategies, which you can see articulated on our website at privatebankingstrategies.com. That includes asset protection, financial privacy, velocity of money. It's not always about insurability at an elderly age. Many people start these policies within 5 to 10 years of retirement, so because they've got a predictable known value and there's no taxable event on withdrawals. The money in and the money out is all in a tax-free economy pursuant to Internal Revenue Code 7702. So, and it's also a way to create legacy waterfall wealth from one generation to the next. So it's actually, the sooner that you get started, the better. And folks that have policies from the time they're children, the values that accumulate, the cash values and the death benefits are truly mind-blowing. But for all of the various other reasons that we articulate in the 7 pillars of private banking strategies, it makes it a perfect place for people of almost any age to engage in that structure.
Yeah, Seth, I think we've also done a podcast on the perfect investment. If you were to list everything you would want in an absolute perfect investment, this is what we're talking about here. These contracts are the perfect investment and have everything in that category, everything that we can think of on the positive side. So if you've never looked at these things before, you owe yourself. Please don't just always be looking. Find out if this will work for you. We have a way to take a test drive here. Folks, you may not be hurt anywhere near as bad as our kids, our posterity, are going to be if they inherit a world the way it's going now.
Yeah, and that speaks to the legacy wealth creation from one generation to the next. And many of our families are strongly motivated by that, and you can create a tax-free wealth transfer from one generation to the next with oftentimes more money than you can create in your own business or in your own annual accumulated wealth. So it's a very powerful tool. And folks, you can find all sorts of resources on our website at privatebankingstrategies.com. And if you haven't been there before, you'll find an offer for a book that Vance and I authored, Secrets That Banks Don't Want You to Know. And that book offer is available to you when you put your name and email address in, and we will make the book available by audio version and PDF. And we highly encourage you to read or listen to that book. It's got a lot of valuable nuggets in there, and listen to some more podcasts that are also all free on our website under the resources tab. We've got almost 100 podcasts as of the date of this recording, which address almost every topic that is associated with private banking strategies. If our book and this podcast and other podcasts resonate with you, schedule an exploratory call with Vance, and he'll have a link to his calendar through an email that we send out to you. And you can schedule that exploratory call and take this on a test drive and how it applies to you personally and your family. So we sure appreciate you joining us and look forward to having you join us again. Thank you, everybody. Thank you, Vance. Any closing remarks?
It's just a pleasure to be able to talk about this. I love this topic. I get to watch families turn their monetary situation completely around and always be successful. Here, you have a chance to win. Government can't control it. The IRS can't take it away from you. So, guys, stay safe out there. We hope that you'll take that opportunity.
Awesome. Thank you, folks.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies Podcast. Click the subscribe button below to be notified when new episodes become available.